Malls growing up as a kid of the 90s was really seen as like a community center. You walked around, tried to see what people were wearing, you tried to meet other people there because the future of the store is everywhere. That's actually an area that we're spending a lot of time on XRC. So what can they do that actually brings people to the mall? We're also looking at ways to take advantage of this unused or less productive retail space, figuring out ways and technologies that can optimize some of the pain points that we're seeing from mall operators and retailers. Because I do think people still want to interact with products in store. So it's not going away. It's just how they do the transaction that differs.
Hello, I'm your host, Mike Gelb, and this is the Consumer VC Podcast, brought to you by Propeller Industries, the leading strategic finance and accounting partner for venture stage companies. On this show, we discuss the intersection of venture capital and consumer innovation. And if you're enjoying the show, please subscribe on YouTube or whichever platform that you're viewing this content. And if you're really liking the show, I highly recommend checking out the newsletter at theconsumervc.com. You'll know when every new episode drops for this podcast. You'll also know the latest fundraising updates and all the consumer deals that are happening over the past week. All content and episodes are for informational and entertainment purposes only and is not investment advice. Our guest today is Diana Melencio from XRC Ventures. Diana manages the entire XRC Ventures investment process across 3 different investment vehicles: their Accelerator Fund, Brand Capital Fund, and Opportunity. Some of their investments include Solo Wave, Naked Sundays, and Billy. They recently released their Brand Capital Benchmarks report in beauty and personal care from pre-seed to Series A, which we talk about on this podcast, and as well as we talk about different opportunities within beauty and personal care and within the future of retail. So if you're interested in those either 2 categories, I highly recommend this one. Without further ado, here's Diana. Diana, thank you so much for coming on this podcast. How are you doing?
I'm doing well. Thank you for having me.
Oh, thank you so much for being here. And this is gonna be a lot of fun. I know we've been meaning to do this for some time.
I know.
I've heard you speak on a number of other different shows, and is read as well some of the articles that you've been featured in. And one thing that really stuck out was your thoughts around what the future of the mall is and what the future of retail is.
Mm-hmm.
And I wonder, could you paint us a picture maybe of what a mall you think that would be successful in this kind of new digital era where yes, people are maybe going back to stores in a post-COVID environment, but at the same time, the mall isn't quite maybe what it used to be in terms of maybe like the place to hang out or the place to kind of come together as it once was. When you like envision of what a mall would look like in the future that you think would work from like a financial business perspective, in terms of the type of stores that are offering, and as well as kind of bringing back some of the maybe the coolness factor. I guess that if it's working from a business aspect, then it's probably working from as well that aspect too, since you're driving people gain a lot more in-store traffic or through traffic there. But what's your kind of take on what the future of the mall or picture of what the mall will look like in the future?
Yeah, I mean, I think malls growing up as a kid of the 90s was really seen as like a community center. You walked around, you tried to see what people were wearing, you tried to, as teenagers or kids, you tried to meet other people there. And I think it's really going to be an effort on mall operators and retailers and brands to find ways to bring that community aspect back because there's all sorts of digital communities. Consumer VC is an example of one, but what is something that you want to or have to experience in person, such as the touch and feel of clothing, um, or seeing what a blush looks like in real life, or tasting a beverage in real life before purchasing it online. So I do think there needs to be an effort to be made around to answer the question, how can we bring communities together again in the mall? Because the future of the store is everywhere. It's the ability to, when you're at a coffee shop, drinking out of a cup, that you can purchase that cup either through like a QR code, or there's retail media networks that are proliferating everywhere. That's actually an area that we're spending a lot of time on at XRC. So what can they do that actually brings people to the mall?
So what when I think about a traditional mall, you have kind of like your anchors, right? You have like your big department stores in like the different, areas. Growing up, I was also a 90s kid. Growing up for us, it was like Hex, if you remember Hex, JC Penney, Nordstrom, kind of like those were kind of like our I think three.
Or like Sears. Sears had everything. It had the tire center, it had a photo store, and then it also had clothes and shoes. I mean, it had everything. But now we can get that on Amazon.
Exactly. Sears, great example. Also like Old Navy comes to mind too for some reason. But like you have these like big, like kind of like department stores, or some ways, like Sears, maybe like an everything store, right? But how do you think about maybe the future of malls when you have these like big kind of stores, big anchor stores, and then you have, maybe smaller stores? Because I know that a lot of people have talked about this digitalization as well, and maybe of commerce, and how we're trying to like put together. And I imagine this is where you and you spend a lot of time in a number of areas in relating to retail, whether it's brands or kind of future retail. But how how do you think about store size overall in terms of do you think that we're going to see like a lot smaller stores in the future that's really kind of focus on optimizing per every square foot and seeing how we can actually like and really thinking about it from that perspective, less department stores, or are we still going to have, in terms of like the overall structure, it being quite similar, but maybe it will be a few like immersive experiences here, or a like a museum of ice cream or something like that, a concept that's like in the stall, that's in the mall. What are you seeing in terms of like just overall? Are we going to see like malls that have a lot more stores, or is it going to be maybe similar, but there's going to be some like innovation when it comes to different stores to actually help drive that through traffic to get people through the door?
Yeah, I think it's all of the above. So I think for the past decade or more now, there's too much retail square footage out there in the US. As a result of that, retailers, mall operators are finding ways to optimize revenue for that excess square footage, whether that's shrinking the actual stores that customers interact with and making room for kiosks that do buy online, pick up in store.
Or like a happy returns or something like that?
Exactly right. Or like the Amazon lockers, all of those things. So I do agree that there is too much square footage. I perhaps I think the mall of the future is really more showrooms of the future, where you can interact with the products online. Maybe they stock some inventory there, but a lot of it is really more from an interaction perspective. Because when you watch people actually shop in stores, they have their phones in their hands, typically price comparing, um, and or for some doing some research. So I do think that brands and retailers alike will have to be more creative about how they use that space. If you do an analysis of the most productive stores in a mall, it is actually those mini kiosks. The productivity levels in those kiosks is very high, um, higher than the average retailer and brand in those malls.
That's really, really interesting. I mean, just from like an inventory perspective, I think you kind of touched on there, and it reminds me a little bit about Bonobos and their story with
Mm, big fan
the
of
guide shop
bonobos.
model. Like the guide shop model, right? Where you go into the store, you can go in and try on, all their products, but they don't actually hold inventory, right? Like you actually have to go and you actually buy it, online, which is very innovative. And I mean, could you imagine where you actually go into malls just to buy on products, but you actually walk out of there with no bags? You literally go in, buy like try on products, but you actually do the transaction in the mall. You actually make the purchases, but it's all kind of shipped to your but it's actually shipped towards to your home, and you actually transact online, still in store, rather than actually holding out of inventory. Or yeah.
Yeah, we're already seeing that, right? Like Bonobos is one, but there are several others that are doing just that, where it's more like the car showroom model. Like you can't get a Tesla off the lot. You can test drive it, but then it will be delivered to your home. So I do think to optimize for margins, for space, for the fact that more people are particularly the younger generation prefers to shop online and have things delivered directly to them. There will have to be some adjustments to how products get to the consumer.
As an investor, when you think about, the future of the shop, the future of retail, um, from like a physical location, experience. What then do you look for when it comes to when it comes to opportunities? What to you then becomes kind of interesting when you're looking about, what the future of the mall could look like? What, for example, or like the future of the store? How does it actually relate, or um or then become, okay, like maybe a thesis that then actually turns into what investment opportunities are that could bring you, knock on wood, hopefully venture like returns?
That's interesting. I mean, those are different answers depending on if you're talking about consumer product investments versus what you're really asking is tech enabled investments. Is that?
Tech enabled investments. Yeah.
Yeah, tech enabled investments. I'm looking for asset light models that don't require a ton of capex, that can maximize revenue for these retailers and for these consumer brands. Retail media networks, which we touched on earlier, is a great example. So it's retailers optimizing the current assets that they already have in place, emails, TV screens, their own website, to bring attention to the brands that they carry through these retail media networks. So that's an area where we're spending a lot of time and deploying capital towards. Um, we're also looking at ways to take advantage of this unused or less productive retail space. We have a company called Philogic that does middle mile logistics, specifically taking advantage of unused spaces in malls. Um, and so it's, you know, figuring out um, ways and technologies that can optimize some of the pain points that we're seeing from mall operators and retailers. Because I do think people still want to interact with products in store. So it's not going away. It's just how they do the transaction that differs.
Yeah. No, that makes a ton of sense. I would say, when you look, do you look towards examples like, is there a mall that you see and you're like, oh my gosh, like what they're doing, the types of stores or products that they're in, or even the technology companies that maybe have partnered with retailers to create different experiences, that is pretty interesting. And maybe that type of model of a mall might come to others. Is there any like particular mall that maybe stands out, or are we still pretty early in all this where not so much? or even a mall, or even like a mall itself that you think has done a really good job like embracing in your mind maybe what the future of a mall could look like, hey, this actually maybe might be a recipe that maybe others, doesn't have to be like the exact same stores, for example, but maybe some of their stores are using in terms of transacting. Maybe you can transact digitally, for example, or really easily in the store when you actually like something, or you can learn a lot more about products more easily in the mall. This is more or in a store because it's more connected, or maybe you find that the kind of anchor just the anchor retailers are doing a much better job, and maybe the mall is, I don't know, helping them do a much better job in terms of like how can we actually utilize space where it actually gets more people through the door and better foot traffic, and that you see maybe what all this kind of evolves into is maybe you see, since we're both 90s kids, it evolves to like, wow, there's really kind of this real like community that's being built around this mall. People actually want to actually attend this mall per se. And hey, maybe this mall, maybe this is actually, maybe other malls could take, some of the ideas that have gone to this one or not. I'm just kind of curious if you've seen like an example of like, wow, that mall, like I actually really enjoy the experience, and there's definitely maybe a bit of a buzz around it, because there really just isn't buzz around malls these days. So I'm just kind of just curious.
Yeah, I don't know if I feel a buzz, but young as a young mother, there are two that come to mind. One is the Westfield Century City Mall, and the other one is the Grove. There's a few reasons why I really like those malls and why they are highly trafficked by other young families. One is they have a family room. The gr- and two is they have playgrounds. So they make it easy and desirable for, I'll just use the young family demographic as an example, for young families to want to come and spend time there because there's something for everyone. They've also been doing, and this is less tech oriented and more of that community building aspect. They're also building in community events. Like at the Grove, there was um, a mothers and baby yoga class in the morning. Or at the Century City Mall during the holiday season, they had those. I don't know if you went to the Century City Mall during the holiday season, but they had performances. They cleared out the middle and they had live live performances. And then there's also within that mall specifically, there's also like breakout areas and fast Wi-Fi where people can come and congregate. It's also helpful that they have a multitude of restaurants at varying price points and a movie center and a grocery store and Equinox. So it's really like a one-stop shop. They also have Boomo Works, which is a kind of like a WeWork for working parents, where they have sitters on site, so you could drop off your little one and then work there. There's also a camp, so you could also drop off if you have more like elementary school, drop them off and get all your stuff done. So I think they do a really good job of finding ways to foster community and draw parents there as a way to make, whatever it is they have to do, whether that's working out or grocery shopping or buying things they need in one place.
Yeah, I feel like as well, and maybe I'm wrong just from the malls that I visit, I feel like there's more gyms now as well in malls too, which make a
Make a
ton of
ton of
sense.
sense. Make a
Um,
ton of
which
sense.
makes a ton of sense. Do you feel, since we both grew up in the '90s, and like I'm just thinking about the movie Mallrats, and and also maybe being a bit of a mall rat as well. Um, do you think that the community and that experience, I know it's looking very, very different now than what that experience was as we're talking what it was in the 90s, but not, in the 90s you didn't have the competition of e-commerce, you didn't have competition of other ways to actually buy products. You almost needed the mall. You almost the mall was necessity might be a strong word, but it was just one of the kind of habits or activities that you did. Do you see that the community aspect coming back in that kind of scale or format that like it was in the 90s? Or do you think that, hey, like there's already like way too much competition here with like e-commerce or being other ways to, purchase products and I don't think maybe so many people maybe are focused on that experience outside of e-commerce per se, that it's never going to be quite like it was.
That's a great question. Um, I don't know that it'll ever be quite like it was, but I do think that the retailers and the brands that will win in the future of the mall are making it easier for people to do what they need to do, meaning find and buy the items that they need and then check out as quickly as possible while maybe participating in some of the activities that are happening in the mall. So an example would be: have you ever been to the Uniqlo store in New York City?
I have not. No.
Okay, so basically, you shop around. There's lots of interactive displays, and then when you're done, you have this. You carry around this bag. You drop it into this bin. Um, it automatically calculates what you have in the bag, and then you pay with your phone, and then you just walk out. You just drop, and then you go, and then you go, and then everything is pretty well labeled in that this section is for men, this section is for kids. So if you didn't want to interact with a human and you just wanted to get in and out, you can do that.
Wow. That's really interesting. I mean, I'm also really curious about the future of those types of things as well, just because I know, like, at least on like the grocery side, this is different, but I know on the grocery side, like Amazon has like cut back on doing that. When
Yes,
you
but that's
had like
because
stuff
their
in the cart
model was
versus not
extremely
versus.
expensive. Like to run one of those stores. So
Oh.
part of your job is to go shopping. So so I did. I think it's in Sherman Oaks, or it's in the Studio City. Whole Foods is like operated by an Amazon Go model. So you take a cart, you do all you do all your shopping, and then you leave. Mostly pretty it's mostly pretty seamless, but they require cameras and a check-in system. There are technologies that um, make it easy for retailers easier to do that type of sort of Amazon Go models, such as the carts or attachments that go into pre-existing carts. Really, I think what's preventing a lot of retail is the high capex necessary to create that level of ease of use for the customer. It's hard for them. It's a huge upfront investment, and then there's a bit of an education process. But if you do it um, with existing assets in the store, I think that makes it significantly easier for retailers. So like a cart reader that attaches to a cart versus spending money on cameras or spending money on buying a whole set of carts for the amount of customers that come through the door versus ones that you could just, you know, put on existing carts. And that's the type of business model that we really like at XRC, is an asset light model.
That's really helpful. Well, I know we've talked a lot about retail. I know as well. You all focus so much as well on brands too, and I know that you recently released your Q1 report about beauty and personal care. Um, can you focus on? Well, first of all, I know that you release these reports quarterly. Why? Where do these? What's the history of generating these reports? First of all, and secondly, what has been some of the biggest differences that you found in 2024 versus 2023 when it comes to investing in beauty and personal care from like the pre-seed area to Series A? Like, what have you seen from like from the macro, from like a macro perspective in the investment landscape?
Okay, there's multiple questions. So I'm going to start with the history, which is that XRC got its start as an accelerator program. Um, Even though now we have multiple venture funds that we deploy capital from. But as a result of sort of our beginnings, we invested in a lot of pre-seed founders that had questions around, well, what do I need to accelerate to get venture funding? And so prior to these consumer focused benchmarks report, we had run just a general one where we did have two columns that split between enterprise SaaS and sort of like tech enabled D2C. And we found that our product um, founders weren't seeing that line up um, with VCs in real time. That there's a large difference between the check sizes, the valuations, the metrics required. Not even like with enterprise software, but with like D2C apps or direct consumer services. And so, and because we heard from founders that benchmark report was so helpful, and since we launched our brand capital fund, we decided, oh, we're gonna run one just for consumer. And then as we started to think about the landscape of the type of companies that we invest in, beauty and personal care is one, but we've invested in consumer hardware. We invested in Terra Cafe. We've invested in a nootropics company called Thesis, and the sort of sales assumptions, year over year growth, the multiples, applied to those companies, the valuations, the check sizes, the investors, they were all so nuanced that we decided to release these consumer reports quarterly and focus on subcategories. I mean, there's even nuance within beauty and personal care, but that's too much work. So, you know, we've made several investments in this space. And so as a result, we've fostered a lot of great relationships, like our mutual friend, Odile at Fab Crow Creation Lab, who participated in this survey. So we decided to focus on beauty and personal care first. Also, because we were seeing so much M&A activity within the space, it just felt very relevant to start with that.
Talk to me a little bit about what the aspects to why you like beauty and personal care. What are the aspects of the business that you find particularly interesting, where it makes sense to invest in, and also what ideally in an ideal world when you're doing your when you're modeling out your investments, what the ideal return is from from like money in, money out perspective. Why is personal care so interesting from a venture perspective?
So the answer to that is so it has some of the highest multiples in CPG. So from an exit multiple perspective, it's usually in the mid to high single digits, sometimes even low teens, very rarely, but sometimes. While most CPG, if you take the average of the past decade of um, investment return,
That's multiple based off revenue, right?
yes, multiple based on, call it trailing 12 months revenue.
Trailing 12 revenue. All right, cool. Thank you.
Yeah, yeah, yeah. Whereas if you take just general CPG, which includes food and beverage, among other things, the average CPG sales uh, sales exit multiple is 3. And so that's why it is so attractive. One, the exit multiples, and that B, um, actually there's multiple factors, but the top two is really those exit multiples, and the second is the M&A activity in the space. The strategics are very active in acquiring new brands, largely because they haven't been successful launching their own internal brands. And that consumers in the beauty and personal care space um, demand newness. And there's also just the science just involves. If you look at some of the more um, successful exits, and by successful I mean just like higher multiples. they really have like a biotech component, K18, Olaplex. So it's more of this like it's more of these like beauty and personal care brands that are grounded in science, that are grounded in clinical results.
How then do you think about, since some of the biggest performing exits in beauty and personal care has been companies, as you say, that are kind of science backed or even founded by scientists. How do you think about founder profile when it comes to beauty and personal care? Is it are you more inclined to invest in founders in beauty and personal care that maybe come from a science background and their the product has some type of innovation that is um, that um, given like the founder's background, if the founder was in science, or vice versa, maybe you, and not to say this could be both, but um, or a founder that maybe is a incredible marketer, or maybe is talent. Maybe it's a talent led business where you actually, and again, these are not mutually exclusive things, but I'm making them mutually exclusive for the purposes of this conversation. But or companies that is much more maybe talent led, or maybe it's a type of product that's appealing to a demographic that maybe is underserved. How do you kind of, because it seems like on the surface, and again, I'm an observer, I'm not an investor, but it seems like on the surface, it seems like there has been a bit of a shift when it comes to what type of founders to back. In that right now, it seems very kind of heavily like science focused in terms of that they want maybe some type of science background there. And I'm just kind of curious when you think about the aspects of founders that to you sound maybe particularly interesting within beauty and personal care.
Yeah, so that's a great question. I don't think what I look for is necessarily dissimilar from that of an enterprise software company investment, in that the ideal founding team would have someone that understands how to make the product, or knows the pain point really well, so can communicate what they want to see, what kind of product they want built, and then someone that knows how to sell it. I think those two people, it could be one, but those two skill sets have to exist in the founding team. Um, and I think the lean towards science based founders, um, um, perhaps as a result of that, a lot of the acquirers in beauty and personal care mandate a lot of IP or substantial differentiation in order to acquire a company. And that's important because the majority of, I mean, consumer products in general, but particularly beauty and personal care, the majority of the liquidity events when you realize your return is through these strategic acquisitions. Um, and and I think all of these conglomerates, I won't name them because I work with some of them. But think about these big beauty and personal care conglomerates. A lot of them have bulked up their R&D teams. So for an incumbent brand, or an emerging brand, to come up with a new and novel technology that their head of R&D can't go, oh, I can do that. Like we can do that. That's a cool sun care brand, but we have this brand has a sun care angle. I think more and more they're mandating that. Um, yeah, because IP is so important to strategic acquirers. I mean, for me, I think if you are leading with science backed, it would be good to have a science backed founder or team member. But to your point, if you're addressing a pain point of an underserved market, like people with darker skin tones, as an example, then that's what you want in the founding team, not necessarily Not necessarily a scientist, though. It'd be great if you had, all of the above.
Right. How something that I keep kind of going over is, and I'm really just curious how you diligence companies, because you might have companies that say that they're, science backed, and they have, you try our product and voila, it's incredible. Something like that you maybe have seen before on the market. At the same time, you also don't want to mislead, consumers in your marketing. And I know that there's like like one of the big, and I'm sure that they all do. I'm sure that in the big kind of acquires are also looking to make sure that what for the science pack one, that what they actually preach is actually what happens, right? How do you think about diligent diligencing a company where, yes, you want them to be innovative and they want the product to be amazing, but at the same time not kind of overstepping that line too when it comes to like their marketing, and maybe they have a really good person that's able to sell the product, but at the same time not being too outlandish when it comes to what actually, if you use our product, this actually what happens.
Yeah, so we do have our R&D experts that we diligence the products with, pay very close attention to clinicals if they have them, studies if they have them, customer surveys if they have them, um, and benchmark them against results and research and reports that we have on hand. We're very outbound focused. So we identify sort of these are the largest, growing consumer product categories. These are white spaces within strategic acquires brand of portfolios. And then it's sort of like the middle of that Venn diagram that we're like, okay, so we should look at, um, for example, what's a good example? Um, Beauty devices. The at-home beauty device category is the fastest. Fun fact: it's the fastest growing consumer product category, just like period. And our portfolio company, SoloWave, is the fastest growing company in that category. And it wasn't SoloWave approaching us; we were doing a deep dive into that market, talking to strategic acquirers, and then outbound looking for companies that were in this specific category. Similarly, for our investment in Naked Sundays, we spoke with, I can't even tell you how many sun care companies, um, to figure out which one that we wanted to invest in. And both of those companies are doing extraordinarily well.
How do you break down what companies that you actually want to invest in? Like, for example, you mentioned just previously that that at home beauty devices, it's like the fastest growing, sector within beauty and personal care. Was it, to make the investment in SolarWave, was it kind of more of like a top down approach? Oh, hey, this category is really really fast growing. Oh, hey, let's then source and find what are the best kind of companies and what they're doing, and then let's kind of be able to pick the best one and try to win allocation in the best one if they are fundraising. Or is it like a bit more bottoms up, where like um, companies kind of come to you all and say, "Hey, let me actually convince you why this is, an incredible opportunity in this space, and why this space is really kind of interesting."
Yeah, within our brand capital fund, it's more the former. It's very tops down. So we do a ton of research, and we look at thousands of companies every single year that fit within the categories in which we are bullish on. We diligence the categories that we're bullish on with bankers, with Wall Street, with strategic acquirers, so that we are, sort of like looking at the right categories, and then from there we we have some internal tools that we built, but we outwardly source companies that fit within that wheelhouse. We do respond to companies that are, and so they don't necessarily have to be raising. We're just like, hey, can we have a chat? We like to get to know founders for a time before we deploy capital, because we try to be very exhaustive in our competitive research. So when a company does, on the latter side, does approach us, sometimes we can't move as quickly as they'd like us to because, oh, this is an interesting category. Let's talk to every other company in that category because we're only going to make one bet, and our average check size is $4 to $5 million, um, with opportunities for more. And so we want to make one bet, and then we want to put our full force behind that, not only in terms of capital we provide, but resources that we provide to that company. We're very well networked with executives and operators. So we help seed board members, advisors, people on the team. Some of it is, potentially compensated via equity, or others is just like, do you just want to talk to the CFO of X company, if you're, to look at your books, or do you want to talk to the head of retail at this company that's doing really well at Ulta because you're looking at getting onboarded at Ulta. And so we pick one. So it's not that we don't look at companies that approach us. It's that we want to make sure we're picking the right one.
This episode is brought to you by Propeller Industries. If you run a high growth business and you're focused on profitability, extending your runway, and improving your operational efficiency, you probably need a finance and accounting whiz that will grow with you. Well, instead of hiring someone full time, what would be cost effective is working with Propeller Industries. Propeller Industries is a leading strategic finance and accounting partner for venture stage companies and has partnered with over 1,000 startups and high growth businesses across consumer products, consumer tech, and enterprise. Some of the brands that they've worked with are Liquid Death, Olipop, Hims, Farmer's Dog, Away, MoviePass, and Giphy. Propeller also provides specialized support for fundraising and M&A with transaction advisory services. Propeller's TA team of former investment bankers and investors can step in on more of a project basis when pursuing full-scale financing and M&A. There's a link to Propeller Industries in the show notes if you want to learn more information. In this past report, what's been maybe your biggest surprise when you and your team were kind of putting it together? When it was, oh, here's a category that is quite interesting that maybe wasn't interesting last year, or maybe this is a demographic that we didn't think that was underserved, and maybe they actually are underserved. I know, like I think it was like a couple of years ago, you mentioned how men's skincare, for example, was like the next big category in skincare. Is there been anything like that on the horizon like this year for you that that you're particularly bullish on?
So it's interesting because we look at data year over year, and we adjust accordingly. So an area that it's not actually beauty and personal care related, so it's kind of off the current topic. But we're spending a lot of time in vitamins, minerals, and supplements, particularly new forms. So interestingly, there's more and more consumers that don't like to ingest pills. So we've looked at things from mints to technology using like Listerine strips to gums to patches. They're all sorts of things. In addition to actually like also looking at the traditional um, pill itself, and gummies and chocolates and liquid supplements. And what we're really looking for there is differentiation and IP, because um, that we've seen and we've been tracking um, companies in the category that did really well and are now stalling because the true differentiation isn't like consumers can't tell the difference. I don't know how it's a nicer way of saying it, but I won't say which ones, but there are, for example, within like the women's multivitamin space, there are some large emerging brands that have stalled or maybe are not doing as well. because the market just got saturated with all these different options, and customers for these products couldn't like tell them apart.
Break down a little bit about XRC. You have XRC Labs, the Opportunity Fund, and the Brand Capital Model. Can you talk a little bit about like average check size, maybe for all three investment vehicles, and how you think about in terms of when you find a company, which investment vehicle that would actually go into if there is interest on your end.
Yes. So XRC got its start. So XRC stands for Accelerate Retail and Consumer. And it got its start in 2015 with the founding partner, Pano Anthos, who partnered with the Parsons School of Design and Harvard Innovation to sort of address some of the issues that he saw happening in retail. And so for a long time, it was just pre-seed investments. I was actually part of the first cohort. That's how I met. That's how I met Pano. When their check sizes at the time,
And I imagine it was amazing to go through, right?
it was good. There were pros and cons. And I'm very honest about it. And I think one of the things that XRC is very good at is we're just like a human AI. We're just like a startup. We get better and iterate with time because we're not infallible. You know, we get feedback from our founders, and we ingest and we try to make the program better. And so from 2015 to like late 2019, 2020, it was just solely the accelerator program. Now out of that program, we invest $200,000, and we invest in pre-seed to seed stage companies that haven't yet raised a priced round. Typically we're the first institutional investor, and that ranges from companies that are pre-product, sometimes pre-launch, I should say, but they have like an MVP, something that they could show us, to companies that are doing, um, you know, making some revenue. The Opportunity Fund. So interestingly, as I said, we listened to feedback. We heard back from our own investors that communicated to us the investment profile of an enterprise software company is very different than that of a consumer product company. So we created different funds to address the differences in terms of the investment makeup.
The LP basis, and is that probably from like the LP basis? So if an LP want to invest in technology, they can invest in which ones of the technologies is the opportunity? Is that right?
Yeah, so the XRC Opportunity Fund invests in seed to Series A enterprise software companies or tech-enabled companies within the categories in which we invest. Typically priced rounds, where a lead investor has been identified, sets the terms. We provide follow-on capital of 300,000 to $1 million is about the average. Some of those are winners, so to speak, of the accelerator, and some of those are just companies that we sort of missed the boat on at the pre-seed stage. So that's the Opportunity Fund. The XRC Brand Capital Fund, our average check size there is $4 to $5 million. We lead, we set terms, we take board seats. I would call it like seed to Series A. That's like really kind of hard, depending on people call it different things depending on what country, which fund. But we like to see like 500,000 to $1 million in annual revenue before we invest out of that fund.
Cool. No, that's really helpful, and I think it's great that you've split it up. You actually have a fund that's devoted to technology businesses, and then you also have a fund that's devoted to brands. Because I've seen a lot of investors, and of course, there's no one right way to do any of this stuff, but I've seen investors that kind of invest both. And it is a different profile when it comes to consumer brands versus technology companies, in terms of maybe what like the returns could be, and also what the overall trajectory is of the company. Um, and I will be honest, I feel like I still haven't gotten like a great answer when it comes to um, when 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 someone has invested in both a consumer brand and a technology company, like mixing the two, like, because obviously it's, in this standpoint, it's one fund, right? And so how does that actually work? Because if they are two different types of businesses, right? You have one that's a very inventory heavy, inventory based business, and the other one that is, high margin technology business. Not to say beauty and personal care is actually very high margin, even though it's inventory based business, but you still have to deal with inventory versus technology. How do you kind of balance those things when it comes to actually modeling out your fund and everything like that? In your sense, how do you think about like what the return profile should be for tech versus brands? I can make my assumptions. Maybe I'll make my assumptions after you say, because I'd love to kind of hear how you think about, as well as even when you're pitching to LPs. I know you don't have to give us all your secret sauce, but in terms of what the kind of ideal return would be for each fund.
That's a great question. I mean, amongst every fund we have, we our goal is to be top quartile. So I'll just start with that, and I can give you sort of the metrics behind that post the podcast. I think Amanda has the information there. But so within enterprise software, one is they have a higher likelihood to IPO, and secondly, the exit multiples are in double digits. So it is easier with a lower equity stake. So you can have a lower equity target as a fund to make your fund on a single investment. Within a consumer product fund, you will need, because of the dilution, typically 20 to 30% every round, and that the average exit is in the, let's call it mid, let's be generous, mid single digits. That's a sales multiple. You will need higher equity concentration in the companies in order to make the fund. So you will need to come in earlier and get a bigger chunk if you are going to get diluted quite a lot in subsequent rounds. Or maybe you can deploy smaller checks, smaller equity checks, but you will need multiple winners at that point to make your fund, and have it be competitive against other benchmarks.
On
Does that make sense?
Yeah, 100%. On the inventory based, I'm gonna call it the inventory based fund, or like the beauty and personal care, apparel, the supplements, these consumables. Well, I guess apparel's not consumable, but these
Yes,
the
products,
products,
physical
physical
products.
products. Yeah, thank you.
Yeah, it's not a line
Save
of
me, save
code
me.
that every consumer can use the same one. It is literally, you have a pill or you have a lotion, and one of those has to go, a different one has to go out to every customer.
So first of all, do you have conversations with found? Because I would say typically what a successful exit looks like, and you can tell me if I'm wrong. What a successful exit looks like in consumer brands is not $1 billion. It's going to be less than $1 billion. It's going to be
On
probably
average, it's 300 million.
average on 300 million. Okay, perfect. 300 million in there, which obviously in tech it could be several billion. From that perspective, do you have conversations with founders and say, hey, look, like what is your goal when it comes to actually fundraising in the future? Is it hey, you want to fundraise like, because I talked to some investors and they're like, we actually love it when the companies raise maybe like a seed series A, but then don't actually need to go up to B, C, D. Um, and kind of keep raising just because what the exit could be, which let's call it 300 million since that's the average of a successful exit. It's just you're going to get as a founder, you're probably going to get too diluted. As an early stage investor, you might get too diluted. So are you having? Am I on the right track here? Is this
Yes, I
and
have those
okay,
conversations.
cool. So also when you're talking with founders, is that also part of the conversation of hey, what is actually from a financial standpoint on the equity side? Is that do you actually want to go out and kind of keep on raising and kind of be on this hamster wheel, or really do you want to kind of stop with us at XRC or at a couple and maybe a couple other funds and then maybe use more creative ways to finance? Not that equity financing isn't creative, but like debt financing or other kind of ways in order to actually fund your growth.
Yes, you actually teed me up very nicely. So the okay, I'm trying to think where to start. Where do I want to start? I want to start with that the average exit is $300 million. I want to, and then I also want to say that in order to get to that $300 million, on average, you have to probably get close or have sightline to $100 million. So that's where earlier in our conversation, I said the three times trailing 12 months multiple of three, which is the average um, for these consumer product exits. Though again, beauty is higher than that. And then on average, these founders own 12% of the company. I'll get you the exact number, but it's definitely below 20%. And so one of the things that we modeled into our brand capital fund is not only leading with an equity check, but also providing working capital loans, and then providing introductions for the founders to leverage, for example, factoring relationships when they go into retail. Because the worst case scenario is a very successful beauty company, which I shall not name, where it's incredibly successful. There's books written about it, and this founder owns 0% of the company. It just got way too diluted, and it's incredibly successful. You see it everywhere. So as a founder myself, I don't want to see that. You know, Pano at XRC, the founder of XRC was also a founder, and so we know that investing in consumer products has to be done differently than the traditional venture model if you want to maintain founder equity.
That's why I think I'm actually really impressed um, with investors that are able to kind of manage tech and also invest in consumer in one fund, because I'm like, well, these are quite different, businesses when it comes to like the actual makeup of them. So really, really great that you actually, because on the enterprise side, or on the tech side, it's more of a traditional venture capital spot.
Yeah, presuming the company is successful and you're raising strong priced rounds, your dilution is not 20 to 30%, or you don't have to go out to market as often as product companies do, because you just need to pay for inventory, you need to pay for stocking fees. Who knows how long your lead time is? The cash turns are like, could be 6, could be 10 months. Um, and that the pain of working capital only gets more acute the bigger you get.
I think what's interesting about consumer as well is that in tech, well, I mean, I guess you said this earlier. In tech, you can have one or two. You only have to have maybe like one or two winners, and if those are really, really winners, then that returns your entire fund. And it's great. And you'll have a lot more maybe zeros, or a lot more
Oh,
kind of
and
break
then
evens.
some,
Yeah,
multiples
yeah,
multiples
exactly.
of your fund.
It's
Yes, that's
it's
right.
power law, and in consumer investing in brands, it's actually not power law really, and it's not really kind of like the traditional venture capital. You will still have winners, but you have to have, maybe if you invest in 10 companies, maybe you need like 4 to do well, right? Or how do you model it out on the consumer side in terms of how many companies you actually need to kind of do well?
Ooh, that's a great question. I'm trying to figure out if I can answer it. But I do model it out. And one of the ways where I think we've created an unfair advantage with our fund is that we have these strong relationships with the CFOs, the head of innovation, the head of M&A, the CEOs, the CMOs. I have regular touch bases with these strategic acquirers, these public companies, like on a bi-monthly basis. And so I have a lot of information about what they want to acquire, what size those companies need to be, and what multiples they're willing to acquire those companies when they reach that scale. And so I believe within our own fund, I have strong conviction that we will have multiple winners. In addition to the fact that we've invested such a large check size that our um, our um, our equity stakes in these companies is quite large, which you have to do if you are an early stage consumer investor in order to make your returns. As you think about, portfolio management, which I definitely do as a former finance Wall Street investor. I think a lot about portfolio construction.
Thinking about portfolio management, how do you think about your overall pro rata strategy? So if you invest in on both the tech side and consumer side, maybe consumer side is just not as much because hopefully, or not hopefully, but maybe the companies just aren't raising like subsequent rounds where, hey, we actually don't need to exercise any pro rata. But how do you think overall about like pro rata as it relates to, the seat that you sit in?
Yeah. So on the technology side, we try to exercise our pro rata in our winners as long as we can, and we set aside reserves for that. That said, we analyze the sort of return profile of, adding that incremental 200,000 to maintain our, whatever it is, 5% equity stake in this enterprise software company versus taking that 200 in a pre-seed company, because we have a multi-strat fund, and investing it and getting, X percent because it's so, call it 7% because it's so early. And so we do juxtapose. We know the founders better, in our when we exercise pro rata. So we have typically more. Well, we definitely have more information and we have more conviction in the founder. But we do um, compare that with, okay, but what our opportunities are in front of us, and then we model it out. We have quite a few different models to as we think about new capital deployment.
What what have you learned most? You see like you see these stories today about um down rounds and companies that maybe were once, unicorns go out and raise at a valuation that was well below what they were kind of in the heights of like maybe like the 2021 era. Just what from your experience, what's your maybe takeaway or or learnings, if you do have learnings from the 2023 2024, where the market has changed, moving forward, and if that's affected how you invest in the future.
I think as specialists and domain experts, I really do believe that we are domain experts in retail, commerce enablement, consumer products. We know the space really deeply. We have in the past fallen in love with similarly domain experts. And earlier in our conversation, we talked about what you look for in founders. I want someone that knows how to build the product, understands the problem in a very nuanced perspective, and then you want someone that can sell it. I think we did not emphasize the selling part enough previously, whereas now um like we are, because you could have the best product in the space, but it's like a tree that gets cut down in the woods. Nobody hears it. And then similarly, you could have the best sunscreen, the best skincare company, the best multivitamin, but if you can't communicate that, you don't know how to reach an audience. It is the same exact metaphor. And so especially with customer acquisition growth on the product side, just being incredibly challenging all across the board. And we've invested in over 30 plus consumer product companies. Um, and we talk to these CPG conglomerates all the time. Everyone's having issues with Meta, um, and their CAC conversions not being as high as they used to be. Um, and so even more so, it's really important to have these founders that, or if it's not the founding team, someone on the team that understands how to talk to the customer. On the enterprise software side, that's your head of sales. If it's not founder led sale, if it's gotten to the point that it's no longer founder led sales.
What's one book that's inspired you personally and one book that's inspired you professionally?
Oh, one book personally that's inspired me. One of my favorite books is this book called "The Things They Carried."
Oh, it's a great one.
Um, I think by Tim O'Brien. Um, And film night's crazy, but I love Shoe Dog. And so if you consider that professional, then I would say Shoe Dog. Yes, not Phil Knight's that's an incredible journey.
So Shoe Dog is number one most recommended book on the show. And the things they carried, I think, yeah. But the things they carried, I don't think anyone has has mentioned that one. So you are original, Diana. You have a book that hasn't been mentioned. That's amazing. Diana, thank you so much for coming on the show. And I know we're over time, but really appreciate you sticking around.
Yes, no problem. Thank you for having me.
And there you have it. It was terrific having Diana on the podcast. Diana, thanks again for coming on the show. If you really enjoy this podcast, please hit subscribe wherever you're listening, whether that's YouTube or Spotify or Apple. And if you really, really love this podcast, subscribe to the newsletter at theconsumervc.com. You'll receive all new fundraising updates over the past week, and you'll be the first to know when a new episode drops. Thanks for listening.